Consensus is for a rate increase mid-2015, right? June 2015?
Yeah, possibly a little bit later because inflation has been so low, and it looks like it's set to stay low. On the other hand, we've got a lot of progress on jobs and GDP as well, so there's a tension between those two sides of the data.
All right, Jim, resolve the tension for us.
Well, this is what the Fed's going to have to do, but I don't listen to Wall Street, I listen to the Fed. The Fed says their decision will be data dependent. I'm expecting weaker growth in the fourth quarter, much weaker growth going into next year. The job situation is not nearly as good as people view because, you lose one $50,000 job and you create two $10,000 jobs. Well, you got two jobs, but the purchasing power of that and what that does for the economy leaves it very weak. We're basically replacing full-time jobs with part-time jobs. So,
but Jim, which data in particular, I mean, which data is the Fed really going to be looking at this year? I keep waiting for people to start looking at the non-core inflation number because that'll look better than the core inflation number as we go into 2015.
Well, Janet Yellen has a lot of data on her dashboard, but if you want to take one number that consolidates both parts of the dual mandate, it's real wages, because real wages gives you some sense of when real wages start to go up, that means employees can demand a raise, and that's a precursor of inflation. It also means labor market conditions are getting tight. So that means she's achieved her one goal, which is improving the labor market, and has to worry about her other goal, which is worry about inflation. So that's when they'll raise rates. But real wages are flat. So that's the thing. If you want to look at one thing, that's the thing to watch.
Josh Wright, haven't we just received some data that shows that people are more likely to leave their job and go hunting for a better, higher paying job than, let's say, in the last 12 months?
That's right, and this is one of the key elements on Janet Yellen's dashboard, the quit rate, people who are willing to leave their jobs. So that's an encouraging sign, because that's been a very stubborn indicator, and it hasn't been moving for most of this recovery. But the other thing that's important to keep track of is, yes, wage inflation hasn't occurred yet, but it may yet occur. We've got minimum wages rising in 21 states next year, and in addition, we're at 5.8% unemployment rate. We could get down to 5.5% by the middle of next year, and at that point, you would expect the job market to tighten, and that's where you might see wage inflation start to emerge.
If the quit rate doesn't deal with the 37.8% of the working age population who are on the couch. This is where labor force participation comes in. It's at all-time lows, and it doesn't show any signs of picking up.
All right, but can't you make the argument there are demographic issues involved in that labor force participation rate, that people are heading into retirement age, they are doing jobs that are not necessarily full-time because they want to and they can?
It's partly structural, Pam, but it's also partly demographic, but it's also partly structural. And this is something Janet Yellen is deeply concerned about. She cares about creating jobs, and they haven't done a good job of it.
And, of course, Janet Yellen not acting in a vacuum, of course, because monetary policy around the world looks to be easing. We've got a chart that shows central bank balance sheets across the developed world. And, of course, the Federal Reserve, if we can show that. Thank you, Claire. The white line is the Federal Reserve. It's been up, up, and up. The BOE has basically stopped with any kind of easing. It hasn't added to its balance sheet. What you want to pay attention to, of course, is the red line for the BOJ and the ECB. That could be set to increase in 2015. All indications are that that will be moving higher, even as the Fed looks to pull back a little bit.
Yeah, the line to look on in this chart, and it's an interesting one, is the blue line, because that's the ECB. All eyes in the first quarter are going to be on whether or not Mario Draghi, the president of the European Central Bank, can deliver on his promise to do whatever it takes and actually get what people consider to be full-scale, sovereign, quantitative easing, implemented out in the market.
None of the LTRO stuff that he's used in the past.
Exactly. You can see that their balance sheet has been declining as they've been relying on these lending operations. They need to go out and buy assets. And that's priced into the market. So if they're not able to do it, you're going to see a reaction.
And Mario Draghi is my favorite central banker because he understands that central banks are basically impotent. So his policy is say little and do less. He's not going to do any large-scale quantitative easing, not for stimulus purposes. The only reason Draghi will act if they get outright deflation, he'll fight that because he has a price stability mandate, and he'll do what he needs to do to save the euro. But he's not going to print money to stimulate because it doesn't work. Printing money doesn't create jobs.
So you're saying that blue line is not going to go higher?
No, it's not. By the way, the one line you didn't have is People's Bank of China. They printed more money than the Fed.
Actually, funny you should mention that. Funny you should mention that. We have another chart, and Corey, I know you want to jump in here. Global liquidity injections, which indicates that if you can compile Brazil, India, and China, they've actually added quite a bit of liquidity into the global financial system. Collectively, almost 8% versus the U.S., Europe, Japan, and the U.K.
Well, and you look at the growth in the S&P 500, and you can sort of say, I mean, at this point, I don't know what they blame President Obama for. The S&P 500 is now up 128% since the end of 2008. Maybe you blame them for putting too much money or encouraging other countries to put money into the system to support equity markets. You know, Josh, is that something you think there's a lot of coordination between the U.S. government and all those other governments that are putting money into the system?
Well, there was a lot of coordination during the financial crisis, but that's changed now. The theme of 2015 is going to be the differentiation across different jurisdictions, and different central banks are doing different things, and that's one of the reasons why yields on Treasury bonds are so low, is because the U.S. dollar is stronger because people expect the Fed to raise rates, and when you've got weakness in Europe, weakness in Japan, weakness elsewhere abroad, we still look pretty good. So even with rates set to rise, people still want to hold Treasury bonds because those are higher yields than you get anywhere else.
But you say that interest rates in the United States are actually high.
Extremely high in real terms. Real rates are high. Nominal rates are low. Real rates are high. Real rates are what matter. Real rates are what determines investment. Real rates can be deflationary or inflationary depending on what they are. Real rates are extremely high, and Janet Yellen's concerned about that. That's why she won't raise them.
But I want to pick up on something you said just a moment ago about how you said central banks around the world are impotent.
Correct.
If they're impotent, then why care whether they're going to raise rates in the first half, second half of 2015? Why even connect what the central bank does to equity prices?
This is an existential question.
Well, I will give you an existential answer. My opinion doesn't matter. Markets care. In other words, they actually can't do anything. Draghi understands that. But other people think they do, so it's sort of what Keynes said, you judge a beauty contest not by the most beautiful contestant, but who the other people think it will be. So if they raise rates with very weak growth, that's a form of tightening. That's going to tank the U.S. stock market, basically, because the stock market...
You think it's going to tank the stock market?
Sure, the stock market's been thriving on free money. Wall Street loves free money. You know, as long as the rates are zero. And
clearly.
I would expect QE4 in early 2016.
But if they're raising rates for the right reasons, because the economy can withstand it, surely that's good news for the stock market.
That's extremely good news, but that's not the data I see, and that's not the situation we have. We don't have a strong economy.
So you don't think that central bank policy has helped the housing industry by offering people the ability to get a 15 and a 30-year fixed mortgage at around 4.5%?
Well, you need a 20% down payment if you're 25 years old and you're struggling with student loan debt. You get
but not everybody is like that. That's not a description of everybody in the economy.
That's
so
true.
I just want to understand, if the Federal Reserve has interest rates where they are now, has that not been positive for the housing industry, and then the knock-on effect, everything you got to put in your house?
Look, it's elevated asset prices. We have two bubbles, stocks and housing. So asset prices are up, no question about it. Wealth effect is very weak, but the asset prices are up. So all they've done is create new bubbles. This is all they do, Pim. They create bubbles, and then they burst. They create them, and they burst.
So I've got another question. You're very concerned about what happens when the Fed raises rates,
right.
obviously.
Right.
But Janet Yellen and the rest of the Fed have been very clear that one of the big debates they're going to have this year is what they will do after the first rate hike and how they're going to communicate about that before it happens. What happens if they just raise rates 25 basis points and it's just a simple firming and then they hold for 3 months or 6 months? Do you think that that would still tank the stock market, just a modest move like that?
Yes, because, I mean, I thought, by the way, I thought they should have raised rates 25 basis points in 2009, so I'm about, 6 years behind that. But, look, they've signaled it, but how, look, they want inflation. The Fed wants inflation. They told us that. We're getting deflation. So how are you going to raise rates in a deflationary environment if you want inflation? That's not how you raise rates. By the way, it'll make the stronger dollar, which is deflationary. So make the dollar stronger, which is deflationary. One of the ways you get inflation, by the way, is cheapen your currency. That's what the currency wars are all about. So the Fed's going to raise rates, strengthen the dollar, slow down the economy in a world where they need inflation. And so there's a conundrum here. It doesn't add up. Unless the economy is fundamentally strong, you're right, Scarlett. If that's true, then they can raise rates. But I don't see that.
Your take is that that's not the case?